Hello everyone, welcome to Fearfully Greedy. I hope you are doing great. In today's episode, I will cover 3 stocks I just bought. I will give you a breakdown of the business, an investing thesis overview, a bit on the net present value, so the intrinsic value I get, and return on that investment if this thesis comes true. Before starting, a quick summary of the channel. I cover a portfolio, value investing portfolio, where I keep deploying capital, 500 euros every month, and we see how it goes. And then I cover investing topics, right? If you think you like this kind of content, consider leaving a like and also subscribing to the channel to follow along on this journey. If you have seen my previous video, since the last one, you will see quite a huge increase from last video, more than 500 euros. And that's because I had some cash from last year. So here we see the deposits. Every month I add the 500 euros, so you can see on the 18th, but I added 6,000 extra euros, right? Because I thought I had this cash and I think it's more fun to have it in the project. So that's why the capital has increased quite a bit. At the moment, the portfolio sits like this. It's 1st of February, and we have Warren Metcoal, Biogen, Intel, Teekay Tankers, Teekay Corp, Berkshire Hathaway, Patla Minerals, and Rao Lietuva. I also have 1,500 euros sitting in cash, which I'm thinking of what to do with them. Maybe add more to these positions, maybe buy something else. We'll see. I will let you know when I do. Also, remember, I add 500 euros every month. I started on the 13th of July, and so far I have added 15,500 euros. So you see this is more than 500 a month. And that's because I had some starting cash, and I also added more because I think it's more fun to play in the project with this money, and you can see more more in action. Stocks I just bought are Warren Metcoal, Rao Lietuva, and Teekay Corp, right? You will maybe not be surprised because I already hold some of these stocks. Maybe Teekay Corp, although it's the similar investment idea, it's a different vehicle. We'll get into that later. But that's because if you're a value investor, it's hard to get a good idea or one that you have high conviction. So once you have it, and if the price is still low compared to what you think it's worth, you keep buying. So that's the idea. You don't get many good ideas because the market tends to be quite efficient. Not fully, but it's hard to come to with these ideas, right? Also, remember, this is not financial advice. Please do your own research and seek professional advice before investing. Also, remember, I have a long position of all these stocks, so keep that in mind. So Warren Metcoal, they are a miner from Alabama. They operate 3-4 mines there, and they are starting to develop another one. And what they are is a very low-cost producer. Although you see coal in the name, it's not thermal coal, so it's metallurgical coal to make steel, right? Very different to make this distinction because one gets a very bad environmental rap, and the other one is very useful, it's very needed. We steal a lot of steel, and we keep building, construction, a lot of the equipment we use every day has steel in it. So I think it's very important to make the distinction, and I don't think the market does it every time, right? When you go to their page, it's very important that when you're trying to buy a stock, you research them a bit. So if you have invested in a company and you haven't been in their investor relations page, I don't think you're doing the job right. So very important to go here because when you buy, you become an owner. So you should see how they are communicating with you, if they are telling things as they are, if they are being honest. So very important. You can go to the events and presentation. They will tell you the main points, the main numbers, but very important to go to the SEC filings also, right? So if we went here, you would see the 10Qs, so the quarterly reports, and then the 10Ks, which are the yearly report. For video quality, what I did is I grabbed some of the main numbers and I made a small presentation, but you should definitely go right inside here. By the numbers, what Warren Metcoal does is they do above 1 billion in sales, between 1.1 1.3 in the 3 years they have been around, because Warren Metcoal comes from bankruptcy from Walter Energy, and what happened is creditors took those very good assets and they made an IPO. So these are some part of those assets. They IPO'd in 2017. So we only have like 3 years of a track record for them. In these 3 years, they have always had like over 400 million free cash flow, so super high cash flow to the market cap, over 1 billion in revenues, between 1.1 and 1.3, minus 2020, which has been a very unstable year. As you can guess, car producers, construction, all has slowed a lot, and the price has fallen a lot for the metric ton. So they tend to have a between 150 and 180 dollars per metric ton, and this year at the end of 2020 they are trading at like $100, $90 on the last quarter, so not so good, but they expect the price to go back up and the consumption also to go back up, right, to a more normal level. Then the employees, they have around 1,400 employees. Then also another very cool development in the company is that at the moment they have these 3 mines, the 4 North, 4 Mine, and 7 Mine, and then they are trying to develop Blue Creek. What Blue Creek does first is they have a production of very low sulfur, which will increase the quality of their overall coal, right? Also, the production for them is, it will virtually double, almost double the free cash flow they generate. And it's a very low cost, like 500 million is what it would need to do the full process. It's over 3 years in the construction, and it will be on a long wall, same as the other mines they do, right? They will have over 50 years of expected mine life, so it's a very long-term project. And as I said, the cost will be super low. Like if you want to dig deeper, you can check a bit the study they made. At the moment, this project is paused because when COVID hit, I mean, they are now at the moment they are trying to keep everything together. The balance sheet is still looking very good, but they don't want to start a project if the demand is not strong and we're not in a normal environment. Then this is what they expect to get from the new development of Blue Creek. So in 2019, they were around $180 per metric ton, and they expect to generate this free cash flow in these different prices, right? So if we go back to 180, we will have around 700 million in free cash flow, right, per year. So pretty ridiculous. Even at 120, this would also be much less, but maybe around 350, 400 million free cash flow for the market cap that we have at the moment, which is 1.3 billion. I think it's ridiculous, right? So big cash generator, but we need stable demand and stable pricing, and I think this will come. So these are the key metrics for the 9 months ended on September 30th. These are the last number. If you can see, everything, almost everything is down, like by a huge amount. The net income, like from 280 million to nothing, like almost negative, like very barely negative. The free cash flow also like this. So they have struggled a lot, but what can you do? I mean, if your clients are steel producers that serve car manufacturers and constructors and all that, this has slowed down terribly. But once consumption comes back up, we will still see like 300 million, 400 million free cash flow and net income. That's my thesis. I think it's the normal trend. And if you want to be in a business like this, which is not the greatest, why is not the greatest? It's because they are very dependent on pricing. Like if the pricing goes to $50, they will lose money, like huge amount of money. So they need the price to be back up, right? But when you have a business that is determined by but when you have a business that the product they generate comes from commodity pricing, like so we have a public pricing, which is still, you don't have any competitive advantage in pricing. What you want to do is have very low cost, and that's why what they do. They are the lowest cost producer in the sector. Then to check a bit about the leverage that they have at the moment, they have a net debt of around 200 million, right? For the cash flows I told you about, the revenues they have, this is not a big amount, right? But still they have around 280 million in liquidity in case things get worse, and we are here for a long while. Then I added Australian coking coal low ball. This is the closest to their pricing. When they price their coal, it's very close to this one. in normal environment. Now, if you have seen the last quarter, they were a bit down. Now they are coming back up. But if you see the futures, you will see that it's over $150 almost until 2023. So we're here for a long while. And I also wanted to point out a bit of the future outlook, because investing in a miner, like in today's day, that we have Tesla, sky high, we have Apple, we have Google, we have Amazon, everything seems to be tech. I think a miner does a great job serving of the world, right? For example, I say they don't mine for electric production, so it's only metallurgical coal, so only steel. And I think steel has a very big component in our daily life. So, for example, steel is the most recycled material in the world. Also, if we see the consumption from the 50s up until now, it keeps increasing every year. In 30 years, I feel we will consume more coal than now. Maybe it will slow down the growth of the consumption, but still is not going anywhere. Then also another con of a miner like this is that there's a new technology, maybe over 10 years old, but we have the electric arc furnace rod. What it does is it has steel scrap, so steel that has already been used, and then recycle it. You melt that with iron ore, coal, also coal, but like 5 times less than in a normal blast furnace. But still, it's 30% of the production. And also, if we need to have more steel in the future, like even if we have to go to space, and maybe steel is not what we'll use for that, but we'll keep constructing more, making more cars, more equipment, and I don't know, the population is growing, so we won't be just recycling steel anytime in the future, right? So blast furnace will keep being one of the main producer like ways of doing steel, and that's a good sign for our business. So about the pros and cons, I wanted to write them down a bit so get a more clear picture. First, they are a very low cost producer of met coal. So if you have a commodity producer, you want to have them a very low cost. Then we have Blue Creek, which is a phenomenal project. I think if it comes through, we'll see huge increases in multiple. Then they have long-term customers, very spread, a lot in Europe, South America, and then some in Asia, right? Then on stable pricing and demand, we'll have very high returns, I think ridiculous returns for the price, and the balance sheet, even in current conditions, looks very solid, right? I don't think they are going bankrupt anytime soon. And for what I have seen of the management, they tend to be very honest. They don't try to sell you the company overly much, right? I know every time you go to a presentation or a call, there's a PR factor, like they are trying to sell you the company, it's their job. They tend to tell you when there's a problem. So that's the main idea for me. Then the cons. So the market values it as an energy coal. They have coal in the name, and that doesn't get a good rap in today's investment environment. Then the pricing of met coal is very low at the moment. So at the moment, if the prices would stabilize at around $100, they would make very little money over time, right? So we need a bit higher price. And then it's a business that is very dependent on price. If the price falls, they don't have pricing power. So their revenues also fall a lot, right? So that's a bit the pros and the cons of this investment. Then to break down a bit the investment. So at the moment it's saying at $23 per share. Market cap is around 1.4 billion. Revenue is close to that, 1.2 billion. That's the average. I think this year it will be much less. Net debt around 200 million approximately. And I expect a normalized free cash flow of around 300 million. I like the management a lot. They pay no dividend. I expect them, once they have developed all the project, they might start paying a dividend. It's a sector that it's quite normal to have these high dividends. And on current projections, I think the dividend will be very, very fat. Then the financial position, I'd say it's 7 or 6. It's not perfect. It's not very bad. So I think it's very good. And the growth, it's dependent on Blue Creek. If they can develop the project, it will go there. I feel the intrinsic value for this stock is over $60. I got that from a net present value calculation, so a DCF model. I can in future videos, if you want, I can share you my standard model for this and maybe do an example with this one. But this gives us a margin of safety over 60% and an internal rate of return of over 14%. So a huge amount. This rate of return is over my discount rate, right? So I'm expecting to add inflation, the 10-year note, and some extra risk factor, right, to my discount rate. But over that, it's 14%. So I think it's a very good bet. And at the end, I will tell you how much I bought. Next up, we have Rao Lietuva, which is a company listed in the Warsaw Exchange, although located in Lithuania. And they are the leading player in the electricity market in Lithuania, and then some other Baltic countries like Estonia and Latvia. They also sell some amount in Poland, with their partners. They also have a wind park in West Lithuania, right? So they also produce some energy. They are vinculated with Rao, which maybe you know, it's a very big conglomerate, energy conglomerate in Russia, and they sometimes work with them to buy and sell energy too, right? Same as last company, you can go to their page and the investor page. They will tell you a bit about the company and everything. But if you go to the reports, which is the main idea here, you can download the main reports, and they have English versions, and they have also converted, because they usually work with zloty. Like, they also have the numbers in euros mostly, right? So it's very easy to understand what they do and what they generate. Same as the previous company, I have made a small presentation with the key numbers. Rao Lietuva has 4 subsidiaries, which is to operate in each of the markets, right? So since sometimes electricity is very vinculated with government, that kind of fees, prices, rules, everything that needs to be approved, it's good to have a company in each one of the countries. And then they also have the 4th one, which is the wind park. So it's an independent subsidiary, but everything is managed from Lithuania, from the main company, right? Then the shareholder structure, there's like 20% free float, but we have a 29% from Skandinavian Baltic, which is an investment fund, like a company. And then Rao Nordic, which comes from Rao also, it's a major shareholder. And that helps us a bit, like, in a sense that this is not a growth company, and what they do with all the net profits is they distribute it in dividends, right? So it's a company that pays a huge dividend. About the company, they are the largest electricity trading company in Lithuania. They have the biggest wind park in Lithuania. They are like some of the largest taxpayer there. And here you can get a bit of an idea how much energy they produce, but by the numbers, they are the biggest player, right? Then I grab this from their reports to get an idea of how much money they generate, what are kind of the profits, and I put it in euros and a bit a better format, but the numbers are extracted from the reports. So in 2017, they were doing around close to 200 million euros in sales, now over 300. And then the net profit, it's always between 10 million and 18 million, like around that. And it's a company that doesn't reinvest a lot in the business because, I mean, you don't need much infrastructure to do what they do. So it's a great business with very little assets. They generate a lot of cash and revenues. The margin is not a lot, because what they do is they buy energy and they sell energy. So that's the difference. It's the profit they make. But you can see that even these are from this year, right? For the 9 months ending in September in 2020. And what you can see is that we're already in EBITDA over 40 million, right? But the net profit, I expect this year to be around 12 million, right? That will be, my guess is the dividend for this year. To give you an idea, that's over 15% dividend. And this is a very constant dividend. Like, for the last 5 years, they have been doing that, and there's no reason for this to change. Then if we check the balance sheet, we can see that long-term debt is around 2 million. It's on deferred tax income, so they don't have any debt. The equity, if you see it, it's nothing, right? So it's almost nothing. It's a company that generates so much cash from no assets, right? So it's I think very great. If you run the numbers, you will see that it's the return on equity or return on capital employed. It's super huge. Then what I told you, the dividend, they pay everything in dividend, right? So the net profit is the dividend, like almost exactly. Sometimes there's a small difference, but they try to seek that payout ratio in dividend. Finally, the pros, the valuation, it's ridiculous. I mean, they are generating around from 10 to 18 million a year, and the price we're getting is around 70 million in euros, right? So ridiculous, like such a good valuation. Then we get paid from first day, from first year. We get a dividend straight out. They are a huge cash generator, the main player in the region. We will use electricity for the foreseeable future, and wind park also added into the business, which generates from some of its own energy. And if you see the margins on the wind park, it's also super huge. What are the cons? It's not a compounder. I mean, it's not like they have a product that can double revenues next year, but they can keep getting bigger market share and increasing the markets, being very respectful with the costs, and they will keep generating cash. Then it's a not followed stock, so no one knows about this. I have seen some funds starting to add it this year, but it's not very followed. So, and then it's from the Warsaw Exchange. If you are from United States, it's a foreign market, maybe very hard to get into. So that can be some of the cons for it. Then about the valuation, at the moment it's trading at around 19 zlotys. That's a Poland currency. And they have a market cap of around 380 million zlotys, right? All will be in zlotys, so it's easier. It's what they use. Then the revenue is around 1 billion. Free cash flow around 70 million. So if you compare the market cap to the free cash flow, it's pretty huge. Net debt, they have no debt. So it's pristine balance sheet. Management, I like. These people are very, very honest. They tell it as it is. They try to keep the ship very clean, the company very in shape. So I think the financial position is looking great. Then you see the dividend, around 17% dividend, and some years it's higher. So it's great. The growth, almost none. I mean, they are expanding their markets, but I don't count on any growth for this model. The intrinsic value I get from the DCF model is around 40 zlotys, so a bit over a double here. And the margin safety, so 50%, and internal rate of return over my discount rate is around 10%. So I'm good with that. I think it's a great investment, great company, very well run, and in a sector that it's expanding. Next up, we have Teekay Corp. To explain this investing thesis, I will have to explain 3 companies, right? That's because it's a holding company that has shares from 2 other companies. And we can see it here very quickly. So we can see 3 companies, Teekay Corp, then Teekay Tankers, and Teekay LNG Partners. So these are the subsidiaries of Teekay Corporation. Due capital requirements on many years ago, they had to like spin off these companies, keep some of the shares, but then get some capital from the market, right? If you have followed the channel, you know I own shares of Teekay Tankers, and this time I bought shares of Teekay Corp, right? But I will explain the thesis on Teekay Tankers, on Teekay LNG Partners, and then the final thesis on Teekay Corporation, right? Here we have the group structure. We have Teekay Corp, the one I just invested in. And what happened is this company holds 35 million units of TGP. This is a limited partners, so no shares. It's called units. And then we have 9 million shares of Teekay Tankers, right? Then they also own some FPSOs. At the moment, this is from last year, so they had 3. They sold 1 of them. FPSOs, they are very bad business, so it's good that they are trying to get rid of them. Then BAMF is getting scrapped, so the costs for that are already added to the valuation. And then Hummingbird, they still have a running contract, but probably in 1-2 years it will also run out, right? They have a contract until 2023, if I'm not mistaken. And what will happen is this asset will be out, and probably the free cash flow that it brings in, then with the cost, it should be valued at around 0, or maybe minus 20 million, minus 10 million. Not a big amount, but still these assets should be out. These three assets should be out in the near term, right? Then the valuation becomes very simple. We have shares of these two companies. Let's see what these companies are worth, and then minus some of the cost of owning these, right? The idea, this is from the last quarterly report, what happens is that the cost they have, so the administrative expenses and general expenses, should be higher. So they charge the subsidiaries this amount. So you shouldn't have an extra cost by owning Teekay Corp, right? That's what the management has promised and implied when you talk with them. Because what you would imply is that if you are running extra costs, like if you see here, we're running extra costs, not anymore. Like in the last quarter, they have implied that this will be like this. So the extra the cost they have, they will charge the subsidiaries. Because if not, you would say, why not just own the subsidiaries instead of the mother company, right? For me, the other thing is that I'm from Spain, so you have a different treatment when you invest in a company that is a major LP, right? So what happens then is that since these companies pay a very high dividend, what it's said in the rules is that they will charge you the higher bracket of taxes on that dividend. So like 37% instead of the 15% that I should be charged in a normal company, right? So that's why for me, it's better to invest in the corp if I want to invest in LNG, right? In Teekay and LNG. First, I will show you Teekay Tankers, right? This is my main positions from the two companies. Tankers, what they do is they ship oil around the globe. They have some set routes, but they can adapt. So compared to midstream, for example, that they also do a similar thing. Midstream, if the oil runs out in one place, they will have to build another pipeline, right? In the sense, these are mobile pipelines, so we will need oil to move around the globe because production and consumption are in different places. So that's what the service that Teekay Tankers does, right? They are mid-size, so not the biggest ships, not the smallest ships, and they are the main player in that side tanker, right? So what happened when COVID hit is that we had a big difference between demand and supply in oil, right? So what happened is we kept producing oil, we had to put it somewhere, and the rates for ships increased a lot because we started pushing this oil to the ship just to store it. And if you see here, the number of ships being used for storage increased like 4 or 5 times, right? So that helps Teekay Tankers a lot. They will make around 400 million free cash flow this year, which is 4 times the usual year. And what's, if you can see here, almost double the average for this for Q3. In Q2, it was ridiculous. So you can see with the huge increase that we had and the usage of the tankers. So what we did with this cash is pay off debt, increase the liquidity, and the debt profile changed dramatically. So this year, what happened is for Teekay Tankers, and the company changed a lot. It got the leverage being much more healthy and light, and that will help it in the future years. Although in another year, it would still be able to pay off the debt. It would just taken longer, right? So it had a very good year for this reason. The other great story for Teekay Tankers is that the average fleet, the age of the ships, is starting to increase while the order book, so how many ships are being ordered, is at minimums. So that will what will make is a shortage of supply of ships, right? So that means higher rates every day, and also we'll have more usage of the float. So that's a trend, a long-term trend that will develop over for the next years, right? Here we can see with the pros and the cons of the valuation, specifically for Teekay Tankers. First, the valuation is super cheap. I expect like 100 million free cash flow. This year we had a huge deleveraging, so that increases very much the quality of the company. The order book, we just talked about that. It's a market that keeps growing. At the end, I will show you some numbers before the final presentation that you will see that although we know oil might not be the future, but it's not the past either, right? Also that the market is slowly growing in consumption of oil. not by a huge amount, but even if we maintain numbers, it's a great business for them. And then the US this past year started being a net export of oil, so that will help them get more trips and so on. So as for the cons, what happens is that we might not have a strong demand mid-term, but over the long term we'll have a very similar demand to the previous year. And the other con is that oil gets a very bad rap. So it's not the sexiest thing, it's not a tech company, but oil will be needed in the next 10, 20, 30 years. Now for the valuation, it's trading at around $10. The market cap is around $370 million. The revenues around 1 billion, more or less. Net debt is still half a billion. And the free cash flow that we can kind of expect in a normal year, it's around 100 million profit. Then management looks very honest. They have been doing this for a long time, and they have cleaned up the company a lot. If you see the last capital allocations, you can see it's very good. For now, no dividend. The financial position is not as good as in the other companies I discussed, but it's a good position. They are not going bankrupt anytime soon, and the growth is pretty non-existent. That's the bad part also. But what we have is, if we run a DCF model on the net present value, the intrinsic value, we're close to $30. So that's like a triple on the current price. So I feel the value is there. Very huge margin of safety, very high internal rate of return over my discount rate. So very good investment for the part of Teekay Tankers. Now let's see what LNG. So what we see here is like the contracts that they have for usage of their ships. For 2021, it's at 96% usage of their fleet. So almost everything is already sold. This starts to become a bond at this point. And then these contracts will renew, and if you see, some of them are up to 2029. So ridiculous long-term contracts. These are the joint ventures. They have also investment in other companies. If you see here, most of them are up to 2025, 2045, 2033. So these start to become like a big bond at this point. Like we know what the cash flows will be in the future. Very little surprises expected. So that's very different business than Teekay Tankers, but also the valuation is slightly different. It's a much more leveraged company compared to Teekay Tankers, and what we see is that they are deleveraging it through the years, and they are starting to increase the dividend payment. For 2020 and 2021, we will have around 750 million EBITDA, right? That's 7.8 multiple to enterprise value, so very, very low amount, I feel, for the quality of business. Now for the valuation of Teekay LNG Partners, I come to the market cap is around 1 billion in revenue. Also net debt, huge debt. I feel it's quite big. They are reducing it, but it's a business that tends to have a lot of debt. Management is similar to Teekay Tankers. You can quite honestly trust them. They seem very trustworthy, and they have been doing very good capital allocation. Financial position slightly worse than Teekay Tankers, I feel, but you can see that the free cash flow is around 300 million compared to market cap. Ridiculous. Once we pay up this debt, this company is good to go. And then we have this dividend, 9% and increasing. Like they are already said that this year they are increasing the dividend. It's at 9% at the moment. Huge amount for the quality of company that it is. I come through the CF model to an intrinsic value between $25 and $28, around that range. So here also big margin of safety too. Then as said, for the TK group, we have this company that owns shares of these two other companies. So the idea is that we minus the cost and finishing of these FPSOs, and then we add how much we believe these companies are worth, and then we get to a final valuation. It's a sum of parts valuation. I also wanted to talk about future outlook for this sector. And although we can see that maybe solar, geothermal, all these renewable energies are growing, compared to the other ones, like the ones we have been having for many years, this change takes a long time. So for the companies, for these two companies, they will be good for many years. Like the demand will be there for these many years, and that's the prediction I make. Although it sounds LNG and oil, not the sexiest thing. I think they are here to stay for many, many years. Then also you can see the crude oil demand increasing every year, like slowly, not a huge amount, but it increases every year, almost every year. So I don't think that's changing anytime soon. Like we will have a very constant amount of demand. Now, if we count for the 35 million units of TGP at $25, which would be roughly around $900 million, then the 9 million shares of Teekay Tankers at $30, that's around 300 million. If we add all that, we take out the debt and we count for the market cap at the moment, what it means is we get a very high return rate. So my intrinsic value, following the sum of parts, would be that the price for Teekay Corp should be around $8. And we're at 246, so the margin of safety is even higher than the two subsidiaries. So that's why I bought this one. Also for the requirements, the tax requirements for being a foreign investor I told you about. So buying Teekay Corp, I keep buying more Teekay Tankers, but I kind of diversify to the higher quality TGP business, right? So that's the main thesis. At the end, this is what I bought. So 80 shares of Water Met Coal at $23, 33.20. Then Rao Lietuva at 350 shares, around 19.15. And then Teekay Corp, 1,000 shares at 262, right? So this builds up each position minus Teekay Corp, that I said it's similar to Teekay Tankers. Between the two, around 3,000 euros invested in Teekay. Then here maybe it's easier to see like this. Water Met Coal, 80 more shares brings me to 230 total shares, over 4,000 euros invested in Water Met Coal. And then Interrao, it brings us over 2,000 euros invested in, right? Maybe easier to see on the Excel spreadsheet. As always, here you have the breakdown with all the amounts, all the positions. Remember, I have a 1,500 in cash, which I'm waiting to see what to do with it. I don't want to wait too much to have this position, but having cash is also good. If prices fall for some of these assets, I might buy more of them, right? Also, I added money weighted rate of return. So when the funds come into the investment, it accounts for that. So since a lot of the cash has been come in the further months since we started, this hurts a bit the performance of the peaks, right? So that's a bit the difference. But yeah, the truth is this one. So how much money you put in, how much money you get. In general, over the years, they will tend to come together, right? Also, down here, remember transactions, dividends, deposits, price history. You can keep track to the exact cent how the portfolio is doing. Well, I hope this was interesting. If you want me to analyze any of the companies you like, leave them in the comment below. Or if you have a topic that you want me to discuss, you can also do that and keep the content coming. Well, please take care, be safe, see you in the next video.